Welcome to Griffonomics.
It's great to be back.
It is Tuesday, February 3rd, 2026. And if you have a portfolio or, even just a passing interest in the titans of industry, you probably felt a little tremor this morning.
A tremor is a good word for it.
Pfizer dropped their Q4 earnings, and, well, it was a moment.
It was a very complicated morning for the market, to put it mildly.
Complicated is polite. I think sobering might be the word I'm looking for. Look, for the last, 3-4 years, Pfizer has been the main character of the pharmaceutical world.
Absolutely. The main character of the whole economy, almost.
They literally saved the world. They had the vaccine Comirnaty, they had Paxlovid, they had cash coming out of their ears. They were, the Avengers of the S&P 500.
They were printing money. It was a historic, unprecedented run of liquidity for a company that size.
But reading this report from this morning, it feels like we're reading an obituary for that entire era.
The hangover.
It's the post-pandemic hangover, exactly. The COVID windfall isn't just slowing down, it is gone, vaporized. The stock is trading like a boring utility company.
It really is. The excitement has just been drained out of it.
And honestly, looking at these numbers, I'm seeing a company that is standing on the edge of a cliff and just staring down.
You are, of course, referring to the patent cliff.
I am. The big one. And that is exactly what we need to figure out today. This isn't just an earnings recap where we, read off the EPS and call it a day.
No, this requires a much deeper look.
We have the Q4 earnings transcript, we have their new 2026 strategic roadmap, and we have the analyst notes from Seeking Alpha. The mission today is investigative. We need to answer one single question.
The big one.
Is Pfizer a value trap, a dinosaur that's just too big to turn around, or are we witnessing, maybe, the greatest pivot in corporate history?
That is the multi-billion-dollar question, isn't it? Because to survive what is coming, Pfizer has to replace a $17 billion hole in their revenue.
17 billion. Just say that number again. 17 billion dollars. That is the size of a Fortune 500 company just evaporating from their books over the next few years.
And they have to fill that hole while the entire market is basically betting against them?
That's the challenge.
So we have a crime scene to investigate. We have a massive hole in the budget. We have 3 massive company-altering acquisitions that cost a fortune. And we have this really controversial obesity drug that people are fighting about on Twitter right now.
The VSPR-3 data.
The VSPR-3 data. We're going to get to that. And I have a lot of questions about why they bought that drug. But first, let's just look at the immediate aftermath. What actually happened in 2025? Because the headline number, it wasn't terrible, right?
On the surface, no, not at all. 2025 revenue came in at $62.6 billion.
$62.6 billion.
Which, actually beat expectations slightly.
That's a lot of money. If you just look at that number in isolation, you'd think, hey, that's a healthy company.
But you have to look under the hood. It is really a tale of 2 completely different companies living under one roof. Okay, break that down for me.
On one side, you have the legacy business, and that's specifically the COVID products. That side of the house is in absolute freefall.
Free fall.
Sales for the COVID portfolio dropped about 40% operationally. And Paxlovid, which used to be this massive blockbuster that you saw on every news channel.
It was everywhere.
It brought in just $218 million in sales for the full year 2025.
Wait, 218 million?
Million with an M.
That's a rounding error for a company like Pfizer. That's nothing.
It is negligible.
Yeah.
It has gone from being the primary driver of their cash flow to basically a footnote in the financials.
So the COVID savior version of Pfizer is officially dead.
Effectively, yes.
Right.
That chapter is closed. But then you have to look at the other side of the house, the new Pfizer, as they're calling it.
The non-COVID business.
Exactly. The non-COVID operational revenue. That actually grew 6% for the full year.
Okay, 6% growth is solid.
And if you zoom in on just the fourth quarter, it actually accelerated to 9%.
Okay, so while the COVID business is jumping out the window, the core business is actually running up the stairs.
That is a very vivid way to put it, but yes, that's the narrative. And that is what management is desperately trying to get investors to focus on.
Right. They want the market to ignore the burning building and look at the new foundation they're pouring.
And they've reorganized the entire company into 4 new pillars to drive this growth.
Okay, let's stop there and double-click on these pillars, because for a lot of people, Pfizer is still just the vaccine company. But that's not really the story anymore, is it?
Not at all. In fact, if you listen to the earnings call, The word vaccine is there, of course, but the word oncology is the one written in neon lights.
So cancer is the new focus.
Oncology is now the primary engine. It makes up about 25% of their total revenue now, a full quarter of the company.
And this is where that huge Seagen acquisition really comes into play.
That's the centerpiece of the whole strategy.
We're definitely going to do a deep dive on Seagen in a minute because that deal was just massive. But what about the other pillars?
The second is internal medicine, which is a fascinating bucket because that is the home of the new obesity strategy and their migraine portfolio.
So that's the consumer-facing growth.
That's where it's supposed to come from, yes. Then you have vaccines, which is trying to move beyond COVID. Things like RSV. Their drug Ibrance had a massive quarter. Sales surged 136%.
Wow, okay.
And of course, their workhorse, Prevnar for pneumonia.
And the fourth one, I&I.
Inflammation and immunology. That one is the problem child right now.
Why is that?
It's struggling a bit. They have some pretty serious patent issues with a drug called Xeljanz.
Ah, okay. The patent cliff again. Which brings us, I think, to the guidance. 2025 was okay because the non-COVID stuff grew, but then they dropped the forecast for 2026.
Yes.
And I think this is where the market got a little spooked this morning.
This is where the record scratched. The forecast for 2026 is revenue between $59.5 billion and $62.5 billion.
Hold on. Let me just do the math in my head. They did $62.6 billion in 2025.
Correct.
The best case scenario for 2026 is $62.5 billion. So revenue is flat, and the worst case is shrinking.
It is flat to down. And naturally, everyone on the call, all the analysts are asking, wait a second, you just spent $43 billion buying Seagen, you bought Biohaven, you have all these new drugs. Why is revenue going down? Where is the growth?
Exactly. If I spend $60 billion on renovations for my house, I expect the value to go up, not down. What's the explanation?
The answer from management is that 2026 is what we call a digestion year.
A digestion year.
They are fighting gravity. The COVID revenue is continuing to vanish. They expect it to drop to about $5 billion total this year. But more importantly, they have a $1.5 billion hole opening up immediately because of patent expirations.
The dreaded patent cliff. We hear this term all the time in pharma, but I want to make sure we really understand the scale of it for Pfizer.
It is the single biggest threat to the company's existence as a growth story.
It's existential.
I think so. The numbers are just that big.
Okay, so let's visualize this. You said $17 billion is at risk. That's through when?
Through 2030. So over the next 4 to 5 years, that is approximately $17 billion in annual revenue that is currently protected by patents, which will lose that protection. It's called loss of exclusivity, or LOE.
Meaning generics come in, the price crashes, and Pfizer's revenue on those specific products goes to, what, practically zero?
Essentially, yeah. It falls off a cliff. And the casualties are heavy hitters. These aren't small drugs.
So who's on the chopping block?
Well, you have Xeljanz, which we mentioned. Its patents are expiring basically now in late 2025 and into 26. That's a $1.7 billion risk right there.
$1.7 billion just gone.
Then you have Vyndaqel, which is a heart medication. That's assumed lost at the end of 2028. But the big one, the one that keeps analysts up at night, is Eliquis.
Eliquis, that's the blood thinner, right? I see commercials for that constantly.
It is massive. It's co-promoted with Bristol Myers Squibb, but it generates about $6 billion a year for Pfizer.
$6 billion from one drug.
It is a monster. And in 2028, the generics arrive.
So in 2028, a $6 billion faucet just turns off.
Correct. So when you ask why revenue is flat despite all the spending, it's because they're running up an escalator that is going down and the escalator is speeding up.
They have to generate $17 billion in new business just to stay the same size they are today.
That's the math. Just to tread water.
That is. It's exhausting just to think about.
This is what management calls the pivotal investment period, but what Wall Street calls the valley of death.
The valley of death.
This period, from 2026 through 2028, is the bridge. They have to cross this bridge to get from the old blockbuster drugs to the new pipeline. And the bridge is shaky because of the sheer size of that patent cliff.
You cannot fix a $17 billion hole by just hoping your existing drugs sell a little better. You can't just price hike your way out of that kind of problem.
No, the math doesn't work. There's only 2 ways out. You have to buy your way out, and you have to invent your way out, and you have to do them both at the same time, perfectly.
Which explains why they went on that insane shopping spree with the COVID cash.
Right. They had the war chest from the vaccine, and they emptied it. CEO Albert Bourla bet the farm on 3 major acquisitions.
And this is where I want to really dig in because the success of this entire Griffonomics strategy, this new Pfizer, depends entirely on these 3 bets paying off.
Absolutely. If these acquisitions fail, the company has no way to fill that hole. There is no plan B.
So let's start with the biggest one, the behemoth, Seagen.
$43 billion.
$43 billion. That is the GDP of a small country. This was their massive bet on oncology. And looking at the Q4 transcript, I saw something that made my eyes water. There was a huge impairment charge.
The $4.4 billion write-down.
Right. $4.4 billion. Now, usually when a company says, oops, we just vaporized $4 billion, that's a disaster. That's a fire the CEO kind of moment.
It's a 5-alarm fire on the income statement.
But I'm reading the notes here, and the tone from management seems almost optimistic. Tell me I'm not crazy. How is losing $4 billion a strategic win?
It sounds completely backwards, doesn't it? But you have to look at why they took the charge. It tells a really fascinating story about the technology they just acquired.
Okay, walk me through it, because my accounting brain is screaming right now.
So before Pfizer bought Seagen, they were developing their own drug for bladder cancer. It's called disitamab vedotin.
Okay.
They had spent years and millions of dollars on it. It was a decent drug, moving through the pipeline. It was their horse in the race.
It was their baby.
It was. But then they bought Seagen, and Seagen came with a drug called Padcev.
Which is also for bladder cancer.
Exactly. So suddenly, Pfizer owns 2 competing drugs for the exact same disease. So what do? They put them head-to-head, they look at the data from both, and they realize that Padcev, the drug they just bought, wasn't just a little bit better.
It was in a different league.
It was categorically superior. It was what they call a category killer. It was so good, it made their own drug obsolete overnight.
So the impairment charge is basically Pfizer admitting on paper, our old drug is worthless now because our new drug is just too good.
That's it, in a nutshell. They killed their own project. That $4.4 billion charge is the accounting cost of scrapping the old project. It hurts the bottom line today. It looks ugly on the earnings sheet. But it proves that the $43 billion they spent on Seagen bought them the absolute best-in-class asset.
It's cannibalization.
It is. But in pharma, the golden rule is, you want to cannibalize yourself before someone else does.
Okay, that makes a strange kind of sense. It's like, we bought the Ferrari, so we're junking the Honda we were building in the garage.
Precisely. And the Ferrari is performing. Padcev grew 15% operationally in Q4. It is dominating the bladder cancer space so thoroughly that Pfizer doesn't even need a backup plan.
So Seagen, the first pillar, seems to be holding up the roof. Let's move to number 2.
Number 2 is Biohaven. They bought them for $11.6 billion to get a drug called Nurtec ODT.
This is the migraine drug, right?
Yes. And if Seagen is a success, Biohaven is looking like an absolute home run.
Really?
Nurtec is absolutely crushing the competition in its class. As of late 2025, it has captured 83% of new prescriptions.
83%. That's not a market share. That's a monopoly.
It is pure dominance. It's an oral medication that dissolves under the tongue. That's the ODT, the oral disintegrating tablet part. So it's very convenient.
And the growth story isn't over, I take it.
Not at all. They have a new indication they're going for chronic migraine prevention, so daily dosing, which is just now entering phase 3 trials.
Wait, explain the difference for us. What does that mean?
Right now, most people take Nurtec when they feel a migraine coming on. It's an acute treatment. Oh no, I'm getting an aura, I'm taking my Nurtec.
You take it as needed.
As needed. But Pfizer is trying to prove it works as a preventative. So instead of taking it once or twice a month when you're in pain, you would take it every single day to stop the pain from ever happening in the first place.
And from a business perspective, that turns a sporadic, unpredictable customer into a daily subscriber.
Exactly, and multiplies the revenue potential for each patient significantly. It's a huge potential catalyst.
Okay, so Seagen is solid. Biohaven is a superstar. That brings us to the third one. The wild card, the one everyone is arguing about today.
Metsera.
Pfizer paid, what was the final number? Somewhere between 5 and 10 billion for this.
Yeah, the deal structure was a bit unique. It was about $4.9 billion up front, but with these things called contingent value rights, or CVRs.
Meaning they pay more if the drugs actually work.
Right, so the total could go up to around $10 billion if it's a success.
And this is their play for the obesity market. The Ozempic killer.
Or at least the Ozempic competitor. Their ticket to the dance.
But we have to be honest here. Pfizer missed the boat. they completely missed the first wave of GLP-1s.
Oh, absolutely.
Novo Nordisk has Ozempic and Wegovy. Eli Lilly has Mounjaro and Zepbound. They are already establishing a massive entrenched duopoly. Pfizer is trying to kick down the back door and join the party very, very late.
They are late. There's no denying that. They have to play catch-up.
And today, with the Q4 earnings, we got the first real look at whether that strategy is going to work. They released the Phase 2b data for their drug, which has a very catchy name, PF08653944.
Formerly known as MET097I. Let's just call it the Metsera asset for simplicity.
Good idea. So this is the elephant in the room, or maybe the elephant that wants to be in the room but can't quite fit through the door. The data came out this morning, Phase 2b results, and I'm going to be honest, when I saw the headline number, I just groaned.
You saw the 12.3%.
I saw 12.3% weight loss at week 28, and I immediately looked at the scoreboard. Eli Lilly has Zepbound hitting 15-20%. Novo Nordisk is pushing numbers way, way higher than 12. So my first question is, Pfizer spent billions to buy a drug that is objectively worse than what's already on the market. How is that a strategy?
I completely understand the reaction.
Yeah.
If you only look at the efficacy percentage,
Yeah.
the raw weight loss, you're right. It looks like a failure before it even began.
It looks like they bought a second-rate product.
But you're looking at it like a scientist, and Pfizer's looking at it like a consumer goods company.
What does that mean, consumer goods? We're talking about a prescription medication.
Are we? Or are we talking about a lifestyle product? Think about the current leaders, Wegovy and Zepbound. What do you have to do to take them?
You inject yourself once a week.
Right. 52 times a year, you have to stick a needle in your stomach or your thigh. Now, Pfizer's drug, because of this specific lipidation technology that extends its half-life.
Hold on, lipidation. Double-click on that. What is that in plain English?
It's actually fascinating chemistry. Imagine you take the drug molecule and you attach a long fatty tail to it, a lipid tail.
Okay, a fat tail.
This fat layer binds to proteins in your blood, specifically a protein called albumin, and it essentially acts like a raincoat for the drug. It protects the drug from being broken down and cleared out by the body's enzymes and filters.
So because it wears a fat raincoat, it just sticks around in your system much, much longer.
Exactly. And that is the key that unlocks monthly dosing.
So 12 shots a year instead of 52.
That's a huge difference in convenience. And here's the bet Pfizer is making. They think there is a massive group of people, the cash market, who aren't morbidly obese, who maybe just want to lose 20 or 25 pounds for a wedding or for the summer or just to feel better.
The vanity market, essentially.
They wouldn't call it that in the press release, but yes. And those people, they hate needles.
I mean, who likes needles?
Right. And CEO Albert Bourla literally compared it to Viagra in the earnings call this morning.
Whoa, stop there. Viagra. That is a very bold comparison.
Think about it. When Viagra launched, it wasn't life-saving medicine reimbursed by insurance for a diagnosed disease. It was a lifestyle drug that people were willing to pay cash for because it improved their quality of life.
And it was a cultural phenomenon.
Bourla believes the obesity market is moving in that direction. He thinks there is a massive out-of-pocket market people whose insurance won't cover Wegovy, who will pay cash for a convenient monthly maintenance shot.
So the argument is, I'll accept the drug that makes me lose slightly less weight because I only have to deal with it once a month. Convenience over raw power.
Exactly. It's the good enough strategy. In the consumer world, convenience often beats raw performance. The best camera is the one you have with you. The best diet drug is the one you'll actually stick with long term.
I don't know. That feels like a massive, massive gamble. You're betting $10 billion that people hate needles more than they love being as skinny as possible.
It is a high-stakes gamble, no doubt. If the monthly dosing doesn't drive patient preference, then you're right, they have an inferior drug in an incredibly crowded market. But if they are right about consumer behavior, they could capture a huge slice of what's projected to be a $150 billion pie.
And they are certainly acting confident. They announced they are launching 10 Phase 3 studies for this drug in 2026.
10. That is a clinical blitz. They are not dipping a toe in the water. They are diving in headfirst from the high dive.
That's a huge financial commitment.
It is. They want this on the market by 2028. They're also testing higher doses in these new trials, which their internal modeling suggests could push that weight loss number up to maybe 16%, which gets them much closer to the competitors.
And I saw something about pills, too. Is that part of this?
Yes. The Metsera deal also brought in oral GLP-1 technology. But the key here is that unlike the current pills on the market, like Rybelsus from Novo, which require you to fast, no food, no water, for 30 minutes after taking it, which is very annoying.
Right, it's a whole ritual.
It is. Pfizer's new tech might allow for pills you can just take normally with breakfast. No fasting required.
That would be a huge game changer on its own.
And they have a combination drug in the works, adding something called amylin to the mix to boost weight loss even further, but hopefully without the nausea that plagues these drugs. So the pipeline is actually quite deep.
So, summarizing the obesity pivot, the data today was okay, not great. But the entire bet is on the monthly convenience factor winning the long game.
Correct. It's a bet on human behavior, not just biochemistry.
Okay, let's pivot ourselves. We've talked about the stuff they bought. Segan, Biohaven, Metsera. But Pfizer used to be an innovation machine in its own right. Are they actually inventing anything themselves anymore, or are they just a glorified holding company now?
They are inventing. And actually, there is something brewing in their internal oncology pipeline that might be even more exciting than the obesity drug, though it gets fewer headlines because, well, the science is a little more complicated.
Tell me more. You've got my attention. What's the next Keytruda?
It is an asset they call PF4404. It's what's known as a bispecific antibody.
Bispecific. That means it targets two different things at once.
Exactly. Think of a standard antibody like Keytruda as a soldier with one hand. It can grab one target. A bispecific has two hands. It can grab two different targets simultaneously.
Okay, so what is this one grabbing?
One hand attacks the tumor's cloak, the PD-1 receptor. This is what Keytruda targets. It stops the cancer from hiding from the immune system.
So it unmasks the enemy for the immune system to see.
Right. But the other hand attacks the tumor's blood supply, a protein called VEGF. It basically cuts off the food source to the tumor.
So it unmasks the cancer and starves it at the exact same time. A two-pronged attack from a single molecule.
That is the theory. And the context here is really important. Just recently, a small company called Summit Therapeutics shook up the entire oncology world with a similar mechanism that actually beat Keytruda head-to-head in a trial.
Wow.
Keytruda is the biggest cancer drug in the world, so this is a very hot area of research, and Pfizer is racing to be the Western leader in this space. They are launching 4 phase 3 trials for this drug in 2026, alone lung cancer, colorectal, endometrial cancer.
That sounds massive. If they can displace Keytruda, I mean, Keytruda is the backbone of modern cancer therapy.
It is. And that's exactly Pfizer's goal.
Yeah.
They want to replace that backbone.
And speaking of oncology, I have to mention the bladder cancer thing again. We talked about the financial side of patch-up, but there's a human side to this story too, right? I saw a note about something called a cystectomy.
This is huge. And it's one of the most compelling parts of the Segan story. One of the trials they're starting is testing Padcev to see if it can replace a cystectomy.
And a cystectomy is the complete surgical removal of the bladder.
Yes. It is a life-altering, just a brutal surgery. You lose your bladder. You often have to wear a urostomy bag for the rest of your life. Your sexual function is affected. Your quality of life changes instantly, overnight.
It's a last resort.
It is. And Pfizer believes Padcev might be effective enough that patients can keep their bladder.
Wow. That's not just about market share or revenue. That is about saving someone from a really, really difficult life.
It is. And from a selling point, if you can go to a patient and a doctor and say, take this drug and keep your bladder versus have surgery and lose it, the drug wins every single time. It's a powerful value proposition.
So the pipeline is actually full of potential. The science seems to be real, but potential doesn't pay the electric bill today. And that brings us to the financial reality, the bank account.
The dividend anchor, as some call it.
Pfizer is famous for its dividend. I mean, my grandfather owns Pfizer specifically for the dividend. It's a staple of the retirement portfolio.
A lot of people rely on that income. And right now, the yield is incredibly high, somewhere around 6.5 to 7%.
That is effectively a junk bond yield from a blue-chip pharmaceutical company. It's screaming that the market is worried.
The market is pricing in a lot of risk.
But looking at the cash flow statement, I'm getting nervous. Can they actually afford to pay it? You just told me they have a $17 billion hole to fill.
It is tight. I mean, it is really tight. In 2025, they generated about $9.8 billion in free cash flow.
Okay, $9.8 billion. That's the cash left over after keeping the lights on.
Exactly. And how much do you think they paid out in dividends to shareholders?
Don't tell me. It's the same number.
Roughly $9.8 billion.
That's terrifying. That's a 100% payout ratio. Every single dollar that came in the front door went right back out the back door to pay the shareholders.
It is what we call a financial straitjacket. The dividend is consuming almost all of their free cash flow. There is no wiggle room.
So they are living completely paycheck to paycheck as a company.
Essentially, yes.
So what happens if something breaks? What if there's a major lawsuit? What if factory goes down for 6 months? They have zero margin for error.
That is why the guidance for 2026 is so strict and, frankly, so conservative. The CFO was very, very clear on the call today. There will be no share buybacks in 2026. None.
Usually when a stock is this cheap, trading at like 9 times forward earnings, companies back up the truck and buy their own stock hand over fist. It's the easiest way to boost the share price.
They can't afford to. They are tapped out. The board has made a decision. They have to protect that dividend at all costs because the dividend yield is the only thing keeping the stock price from collapsing completely.
It's the floor under the stock.
It's an anchor. It holds them steady in the storm, but it also stops them from moving very quickly.
So where does the extra cash go, if they find any?
Any extra penny they find has to go to paying down the debt they took on to buy Segan. They're trying to deleverage, get their debt down to a more manageable 2.7 times earnings.
And they are cutting costs, too.
Aggressively.
Yeah.
They cut $4.5 billion in costs in 2025. They are targeting another $1.2 billion in 2026. That's a total of $5.7 billion stripped out of the company's operating budget.
Where does that come from? Is that just layoffs?
Partly, yes. But they're also leaning very heavily into AI. They mentioned it multiple times. Using AI in manufacturing to improve yields, using it in marketing to target doctors more efficiently. They're trying to do more with less.
And they have to. They maintained a 76% gross margin even while sales were flat, which is, I have to admit, pretty impressive discipline.
It is. They're managing what they can control very well.
So let's bring this all together. Let's land the plane. We have a company that is fighting for its life against a massive patent cliff. We have some genuinely exciting new drugs, but they are years away from peak sales. We have a massive dividend that is eating all the cash.
It is a very complex picture. There's a lot of moving parts.
So what is the final verdict? If I'm an investor looking at Pfizer right now, what am I actually looking at? Is it a value trap?
I think the best way to describe Pfizer right now is a bond proxy with a call option.
Okay, break that down for me. What does that mean?
The bond proxy part is the dividend. You are getting paid a safe, steady 7% a year just to wait. That is your safety net. It's like buying a corporate bond.
So your downside is protected.
It's protected by that dividend and by the valuation, which is already at rock bottom. It's trading at a PE of like 9. It's hard for it to go much lower without going out of business, which, isn't happening.
And the call option part.
That's the pipeline. That's your lottery ticket. If the monthly obesity shot actually works and captures even a small slice of that $150 billion market, and if the bispecific cancer drugs become the new backbone of therapy, then in 2029 or 2030, this stock could explode upwards.
But you absolutely have to wait until 2029.
That is the catch,
Yeah.
and that's the bear case. The bear case is that the math is just impossible until then. The new drugs might work, but they were just filling the hole left by Alex and Xeljanz. So you just tread water for 3 or 4 years, collecting your dividend.
And the bull case is that the market is totally underestimating how big these new drugs could be.
Exactly. The bull case is that Wall Street is looking in the rearview mirror at the COVID crash and the patent cliff and completely missing the new engine that's being built under the hood. If that obesity drug hits, the whole narrative changes overnight.
It really does feel like a transition year, a digestion year, as you said earlier.
It is. The company's slogan for this is risk-defined, portfolio protected, which I think is pretty accurate. But you have to add patience required at the end of it.
Before we wrap up, I just want to go back to that Viagra comment from Bourla, because it really stuck with me all morning.
It is a provocative thought,
Yeah.
a really interesting framing.
If Pfizer actually succeeds in making weight loss a monthly lifestyle subscription like Netflix for your waistline, paid out of pocket by the consumer, does that fundamentally change how we should view pharmaceutical value?
It might. I mean, traditionally, pharma value is based on medical necessity, saving lives, curing horrible diseases, getting reimbursed by insurance companies and governments.
Right. It's about treating sickness.
But if you move into this world of medical consumerism, where patients are paying cash out of their own pockets for convenience and lifestyle enhancement, the total addressable market changes completely. It becomes less about what insurance will pay for and more about what people are willing to pay for.
And people will pay a lot of money to be thin and healthy with minimal effort.
History suggests they will. It could unlock a market that's even bigger than what the analysts are modeling.
It's going to be fascinating to watch. The scorecard for the next year is set. We need to watch those phase 3 trial readouts in 2026. That is the only game that matters now.
Agreed. The quarterly earnings are just noise at this point. The clinical data is the signal.
Well, we will be watching very closely. Thanks for diving deep with us on Griffonomics.
My pleasure. It was a lot to unpack.
And to you listening, thanks for sticking with us. We'll catch you on the next Deep Dive.